Hi, thank you for joining us for our live webinar on how to analyze banks and the introduction to CFD. I'm Eric, I'm your presenter for today. We'll be starting the session proper at about 7:02 p.m. So let's give some time for our friends to join us. Meanwhile, enjoy your dinner, enjoy your break, and I'll speak to you real soon. Hi, welcome back again. Thanks for joining us for our live webinar on how to analyze banks and an introduction to CFD. So once again, I'm Eric. I'm an account manager here with Phillip Futures. In today's webinar, we'll be discussing on various metrics that we can use to analyze banks. And before we begin, I would like to do a sound check. So if you can hear me loud and clear, please type yes into the question box. And during the webinar, if you have any questions regarding the topics that we are talking about, or also any questions that you have regarding the services and products that Phillip Futures provide, please feel free to type them down into the question box, and we'll go through and then make sure that all your answers can be answered tonight. Right, so and then we'll address them during the Q&A at the end of the webinar, or during the webinar if the topic, the questions you ask is in relation to what we are discussing, then I will also try my best to answer your question. Okay, it looks great that everyone can hear me clearly, so let's begin tonight's webinar. Okay, as I said, this is tonight's topic on how to analyze banks, and also just give you a very brief introduction into the CFD product, as well as the MT5 platform to which our CFD products is traded from. Okay, so just a very quick disclaimer. Later on, I'm going to show you some financial data, financial numbers, as well as some charts. Just do note that all this information provided is for educational purpose only, so it does not construe any recommendations from us or from myself. Right. In fact, some of the charts that you see or the data you see could be a little bit dated. So if you're interested in any of the stocks that we mentioned about, please remember to do your due diligence, to look through the numbers, to check through the latest data again, to make sure that it is still in line. Okay, about myself, I'm Eric. I joined Phillip in 2004. Currently, I'm an account manager here with Phillip Futures. So been here for 17 years. Constantly, my job here is firstly taking care of my clients, doing research on the markets, and then also sharing those research with my clients. For those who are very new, I also will have sometimes we'll have one-to-one sessions to be able to guide them and coach them on how to go about selecting the investment products to invest in. Okay, so depending on, of course, different of my clients, they have various trading or investing experience. So then my session with them generally will be catered according to their experience level. Okay, so very quickly, today's presentation scope roughly cover into 3 parts. So for the first part, I'll cover very briefly on introduction to MT5, our CFD trading platform, as well as an introduction to CFD product. And then the part 2 is the main meat of today. On part 2, we'll cover about an overview of the banking system, as well as how to analyze banks. So going to cover on the various metrics that we generally look at, and from then on, how you select which are the right banks for you to invest in. So towards the end, I'll take some time to introduce some banks that I think it may interest you based on current climate. These are the few banks that I feel that based on their financial metrics that you can take them to consideration. So that will be towards the end. And I'll also be doing some promotions, explaining some promotions that we're running. Okay, so to start off, what is MT5? MT5 is basically just a trading platform, right? In short for MetaTrader 5. So if you have traded some forex products before, you should be very familiar with MT4. So MT5 is just another version of MT4. So, but in Phillip Futures, MT5 is not just a trading platform. MT5 is also a trading account. It is an account that is standalone by itself, separate from our futures trading account, or if you are a stocks investor, it's separate from the stocks trading account. So with this MT5 account, it allows you to trade forex and CFD. So forex is foreign exchange. CFD stands for contract for difference. There are many products that we can trade out of CFD, and to which I will explain later on. So the key features of why people like to use MT5 is firstly, it has a single settlement currency, which is USD. So some people prefer it because it really there's no hassle for them to consider about the various currencies that they need to be hold. At the end of the day, everything will be settled in CFD, in US dollar. So it is also an auto liquidation and a preset margin criteria. So what this means is that when there's a margin call, the system will automatically cut the position when the criteria has been breached. I'll touch a little bit on that when I explain the CFD product. MT5 is also a zero commission platform, so there's no com when you trade. The charges you need to, or rather the cost to a trader will be the spread and the swap points, right? So it's a multi-chart platform, so you're able to view multiple charts. Most of the indicators, if you are technical analyst guys, most of the indicators is out there, is available on MT5. And on top of that, what some people like about MT5 or MT4 is the use of expert advisors. So these are third-party program, third-party provider that provide some programs that they will then do the program will do some auto trading for the user. So if you are a person who is very in tune with IT or programming language, you may be also very interested to learn this platform and to write some code yourself, or to do some tests to run your trading strategy. Okay, so this is a look on how the MT5 platform looks. So you have towards the left portion here, you have the price screen, the indicator screen, and then over here is the charting. At the bottom is where you have your account management, your trade histories, and then all the various controls. So it's pretty easy to use, and but do not worry, right? If you are very keen to try this out, we do have a demo account for you to play around with, to get yourself familiarized with it. And if you want further guidance, we can also arrange for a one-to-one coaching, whereby personnel, myself or my colleague will be able to then guide you through over Zoom or if in future when the situation allows, can meet up face to face to also guide you on how to use the platform. Right. Okay, next, what is CFD? CFD stands for Contract for Difference. So over here, it is a standard definitions of CFD. But what actually CFD is in a simplistic form is that it is a contract, right, between a buyer and a seller. So, or rather with the CFD provider as the middleman. So when you are a buyer of a CFD contract, you are actually just speculating that the price will go up. If you are a seller of a CFD contract, you are speculating that the price will come down, right? So CFD then is a product that allows traders and investors opportunity to profit from the price movement without actually owning the underlying assets. So therefore, CFD is a generic term. It can be a CFD for various forms of assets, like stock index, commodities like gold, crude oil, or it can be a CFD on a currency pair, or it can also be a CFD on stocks, which is basically our main topic of today, because today we are talking about stocks, and not just any stocks, but the bank stocks, right? So key features of CFD is that, as I mentioned, allows you to trade in both bull and bear market. So if you are holding on to some position, you want to do some hedging, CFD is one product that you can consider. Or rather, you do not hold any position, but you have a bearish view on the market or on certain stocks. CFD is also a product that allows you to do short selling, right? So there's no expiry date, no risk of delivery. CFD also allows you to trade in a smaller contract size. It's a leverage product, so it allows you to trade at a higher contract size than what your equity allows. It is also zero com and multiple asset available, as I mentioned, commodity, stock index, stocks and shares, and so on. So basically, roughly how CFD works is exactly how any form of financial trading product works, right? At the end of the day, a trader, a buyer is trying to buy low, sell high. A seller is trying to sell high and then buy low, right? So, but what CFD is good at is that it allows the trading of this CFD on various asset group. So it can be CFD on crude oil or other form of commodities like gold, silver, or it could be CFD on stock index or even stocks, the stocks and shares like DBS, OCBC, UOB, just to name a few bank shares. And of course, in the US, the JP Morgan. And not just the bank shares, but any other shares that is provided by Phillip Futures is available on this. You can do so by doing the CFD trading. And also, we do have cryptocurrency CFD as well. So as I mentioned, CFD is traded on leverage. So that is a key feature, and that is also the key risk in trading CFD. So therefore, individual investor and trader, you need to take note of your own risk tolerance and be mindful of not over trading or not over leveraging, because one of the key risks is that you could be right in your view, and yet in the short term, you'll be hurt by the market volatility if you have over leverage up. So leverage, often I tell my clients, is a double-edged sword. So you can use it if you can wield it well, or if you don't use it well, you can end up hurting yourself. Right. So another features or the margin requirement for any form of leverage product that you use, be a margin account for stocks, for CFD, or for futures account or forex trading account, as long as they are traded on leverage, there is this margin requirement portion that you need to be aware of. But what MT5 differs from the rest is that MT5 has an auto cut features. So the auto cut criteria is that the equity must not drop below 50% of the initial margin level. So let's say, for example, if the initial margin level is 1,000 and the equity in your account drops to below $500, then therefore you will then trigger the MT5 AutoCAD features to which the system will come to do the AutoCAD for you. So of course, in every features, there's always a good point and a bad point, right? The good point is, of course, in this case, it protects your account from further loss. You know, especially we trade in the many of times you trade in products that is traded all over the world 24 hours a day, and we can't be watching them all the time. So sometimes when certain of these risk criteria is being breached, the system will actually cut for us so that we will not end up suffering too much, even further losses. So yeah. Okay, so roughly I'll cover on the part 1 about introduction to CFD and MT5. Of course, during these short sessions, I'm not able to explain everything, but we don't rest assured we do have product info sheet that you can download from our website, or if you are interested, you can also request it from us during the feedback at the end of it sessions. There's feedback. We can submit some feedback form. You can then request for the product info sheet to be sent to you, so you then can read up on it. And if you need help or further explanation, you can also arrange for a one-to-one coaching session with us, so then we will explain it further to you. Right. So then let me get to the main topic of today about analyzing banks. Right. A lot of Singaporeans likes to invest and trade in banks. Well, if you trade in Singapore stocks, in fact, well, the common index that we always look at is STI, Straits Times Index. And we know that the Straits Times Index is majority being controlled or being influenced by the 3 banks, which is DBS, OCBC, and UOB, because the weightage of these 3 banks add up together is like almost close to 50% of the entire STI. So whenever the banks move, the STI will move, right? So and that's not just peculiar to our Singapore market, right? Because even in overseas markets, even though the banks do not have such a huge weightage on their stock index, but it does have a huge weightage or determinant in the direction or the movement of the economy. And that's really because if you think about it, in any form of industries in Singapore, right, or in any country, they will all need the bank services in order for the business to work, right? Because they need fundings, they need cash flows, they need to banks to service them in their transactions. You know, when goods are being purchased, services are being purchased, money will flow to and fro. So all this, you have banks in the middle servicing to the needs of the economy. And if you look back, you know, from maybe 50 years ago, you know, when Singapore first got their independence until now, right, industries come and go, right? During the early days, we have a lot on maybe manufacturing, right? Because our population at that time is not as highly educated as the Western nations. So a lot of the maybe low-end manufacturing jobs are being passed on to us, right? So, but over the years, you know, as the economy, as the country progressed, the industry changed, right? But one thing never changed is the bank, right? The banking system, right? Essentially, they're doing almost the same thing, right? Of course, they have more tools right now. They have better looking platforms right now, right? But the underlying of it, right? The transaction, the loans, the deposits, right, is about the same, right? So therefore, understanding banks, it does help us to be able to understand the economy or understand the market and be able to also understand how to invest well in other industries, stocks in other industries as well, right? So there are different types of banks. In Singapore, basically what we see is the 3 local banks. So they basically does everything, right? But if you go to a larger economy like the US, they do have banks who are very specialized. So over here, this is being extracted from JP Morgan annual report. So over here, it shows that the various segments that JP Morgan is being involved in. And in fact, JP Morgan is the largest bank in the United States, and possibly the largest bank in the entire world. These few segments that they're covering in, basically it covers everything that the banks touches on, banking, all the banking sector touches on. So firstly, you have the consumer bank, and then you have the investment bank, commercial bank, and then you have the asset fund management. So okay, consumer bank is roughly basically for people like us, retail investors or retail people like you and I. You know, we put our money in the bank, we take our car loan, we mortgage our house, you know, and we do our investment, we use credit cards. So everything that we do, revolving our life according to our finances, it covers over here under consumer banking, right? Investment banking are more for the corporates, whereby, you know, you have companies like recently Singapore have a lot of these corporate actions, SIA issuing the MBS bonds. Then you have Sembcorp Marine also issuing rights. So these corporate actions basically, or you have companies coming out issuing bonds or coming on to IPO. So this basically fall under the investment bank portion. They are the one that help this corporation does all this thing of fundraising stuff. So in the US, you have Goldman Sachs, who's a very well-known investment bank, who primarily their core strength is in investment banking, not so much on the consumer banking. Commercial banks is more like loans as well, but it's more for corporates. It could be SME, it could be listed company. The asset management is for you and I, or even for corporates who are doing investment, right? Investing in funds, investing in shares, they fall under the asset and wealth management portion. Okay, so when we come to analyzing stocks or any form of company, the very important question that I always ask myself is how does the company make money, right? So in this context, how do the banks make money? Okay, over here I show a screenshot on the annual reports taken from annual reports of DBS. Okay, if you have a little bit background on this accounting, you know about income statement, you know about balance sheet, you know about cash flow statement. So you know that for when we look at study a company, the top line is always start off with revenue, sales, right? How much did the company sell? And then you follow on with the cost of goods sales and so on and so forth, right? But for banks, it's different, right? They don't have sales, there's no gross profit or what, right? So basically what you can see is any banks you go to, this is roughly what you see here. You will see two portions, one portion showing the net interest income, the other portion showing the non-interest income. So essentially, and most of the banks you go to, their income source comes from two portions, right? Interest and those non-interest, right? So net interest, okay, maybe this will explain better, right? So basically, I like to classify it into two portions. One is under recurring income and one is under non-recurring income. Recurring income means that once you secure the customer, the income keep flowing in, right? So under recurring income, you have the major portion here, which is the net interest income, which is loan, L-O-A-N, right? So when we borrow land from the bank to buy a car or buy a property or take out a personal loan, could be for our renovation, could be for the studies, or for businesses who take out loans. So these fall under the interest income, right? So how the bank earn the interest income is that banks will collect interest, right? When you take out a loan from them. So these are the interest income that they have. But on the other hand, banks will also need to pay out interest to the depositors, which is people like you and I as well, right? We put our money with the bank, we expect some interest to be paid, right? So net interest income is basically the difference between the two, right? So what a bank actually needs to achieve is to earn more interest income than the interest expense that they need to pay up to the corporates or to the individuals who hold their deposit with them, right? So then the difference is the net interest income that the bank earns, right? But apart from that, there are other form of non-recurring income that the bank earns. It could be through fees, for example, if you credit card, you late payment, they charge a late payment fee, annual fee, or like when they do some, this is mainly for the corporations, when they help them to integrate maybe their system to the bank system for the collection of transactions, for collections of revenues. So, and then the banks may charge them certain fees for doing such integrations. Sales commissions, that is for banks who also sell certain products, even investment products or non-investment products. Then they may collect sales commission. So these are transactional, on a transactional basis. As and when a customer does all these transactions, then the fees will be collected. So they are non-recurring, right? Whereas for the loans, once you secure the loans, it could be for 10 years for the car loans, or 30 years for housing loan. So this will be recurring, right? Of course, in between, the customer may go join another bank, or get a loan from another bank because they have better deals. But all in all, it's about the same, right? Because you lose some customer, you gain some customer, right? But I'm just going to briefly touch on this last part, this small portion here, the dollar sign. All right, this is basically the wealth management income. Okay, wealth management income. This is taken from DBS annual report, right? The CFO mentioned this, that our wealth franchise representing 20% of the group income continue to grow. AUM rose 7% to 264 billion, though income fell 7% to 2.87 billion, right? So basically, what this sentence here tells us is that for wealth management, their take rate is about 1.1%. So out of the 264 billion assets that they manage for the customer, they receive 2.87 billion, right, in income. All right, and the reason why this is recurring is because usually when customer invest with them is for long term, so they leave the assets there for long term. So of course, as the wealth manager must do the job well in helping the customer to grow the fund. As you continue to do so, the income, the assets will remain there, and then they'll continue to earn this management fee. So increasingly, we see that a lot of banks are also focusing on this part, because in any form of business that we do, we always like to have recurring income because it is more secure, right? It is more predictable. You won't have a point whereby you do not know next month what you're going to earn, whether this customer, whether the customer is going to buy more stuff from me again. So having recurring income is more secure, is more predictable. That's why a lot of companies, even the banks, they like it. They like it. The interest income used to be that portion, but because of the macro economic situations, you will have noticed that the interest rate has just been falling for over the last 10, 20 years. They did prop up once in a while, but the trend has been more towards the downside. So the bank net interest income from that portion has generally been squeezed because interest rate is beyond their control. Is based on macroeconomic factors and also being decided by the central banks. So, but the wealth management is a portion that is well within their control. But even with that portion, for most banks, right, the net interest income still take up the major percentage of their overall income from portion, right? So this is a extract from the JP Morgan annual report. So you can see here their net revenue from wealth management is about 14 billion. The assets under the management is about close to almost close to 1 trillion. So if you take that, you can calculate that the take rate that they collect is about 1.4%. Right. So today's session I'm going to cover more on the net interest income because that is a portion that most banks earn their income from. Even though over the years we do see a trend that it is, in terms of percentage wise, it is shrinking, right? Not shrinking as in they're earning lesser from their interest income, but shrinking as because the bank are also trying to diversify to earn more from the non-interest income as well, right? But nevertheless, it still take up the major percentage, between 60 to 80% for most banks. JP Morgan, I've just shown you, their net interest income is about 45–46%. For DBS, our local banks, later you will see that it has dropped from 60% to 50%, right? So that is the underlying trend, right? Nevertheless, when it comes to analyzing banks, interest rate still plays a major portion. Every time when the Fed chairman says something about adjusting the interest rate, you will see that the banks will usually react, because investors will react according to the news of the interest rate adjustment, right? Because they know that this interest rate adjustment is going to affect how the bank earn from their net interest income, right? So basically, this diagram here shows how the interest is being earned. You have a savers, you and I, who deposit our funds, money with the bank, right? The bank will then take our money. It's not going to leave them either, right? Otherwise, they're going to lose money because they need to pay us interest. So they're going to take the money here and loan it out to borrowers, which could be you and I as well, right? Or it could be corporations who want to take a loan to expand their businesses. But no matter who borrow from the bank, they will eventually, at the end of the term, need to repay the bank back the loan. Or if they want to, they can usually renew or by borrowing from another bank. But no matter what, this money need to be returned together with interest payment back to the bank, right? So the interest the bank collect from the borrowers, right, minus off the interest the bank paid to the savers, right, that will then equal to the net interest income that the bank earns. Okay, so typically when you look at the annual reports on the banks, or maybe if you have access to maybe some Yahoo Finance source, when you search for their these financial statements, you may also see information that tells you what are the income that the banks are receiving and what are the payment that they are expenses they are paying out. So under net interest income, you have the loans portion, right, to which they collect the interest from, and that will then total up to the net interest income. And you have the depositors to which the bank need to pay the interest out to, and that will equate to the total interest expense. So net interest income is basically total interest income minus total interest expense, and you're equal to the amount, and this is the income that the bank received. So over here, I want to point this out to you. This is the first matrix that we are going to look at. It's called the net interest margin. So net interest margin is basically the net interest income that the bank earns over the assets that they have. The assets means that these assets that they use to in the business operations. The assets that they use to loan it up as a portion of the loan to the borrowers, right? So, so as you can see, the higher this number is, the better it is for the bank. So you will want to, if we have 3 similar banks, and then everything else is the same, but one with a higher net interest margin is definitely better than one with a lower net interest margin, because when the central banks lower the interest rate, then it's going to affect the amount of the interest income that the banks will receive. So therefore, the interest margin will be squeezed. So if a bank has a higher buffer to start with, then the bank will usually end up better off, because you'll still be squeezed, but at least he got something there for them to squeeze at the first place. Whereas compared to one that with a very low, very tiny margin, then you'll be in a much worse off shoes. So having learned how the bank earns its money, we will then want to know what the bank needs in order to do its business, right? So if you look at the balance sheet, there's always these two portions. We have the assets and then we have the liabilities. So for the bank, it's no difference. Of course, the bank do have their own other assets, like the buildings, that are fixtures. They do have other liabilities that they may need to short-term or long-term as part of the business operations, right? But in terms, I would just want to bring your attention when we look at assets and liabilities for the bank, to look at it in terms of loans and deposit, right? Because it's a little bit different from how we think. Because for us, for me, let's say for myself as an individual, if I have a sum of money I put in the bank, right? That money I put in the bank is my asset, right? But then I go and take up a loan from the bank to buy my car. So the loan that I took up from the bank is my liabilities. So in this of my deposit and the loans, right, to the bank, it falls under different portion of the balance sheet. Because my deposit, which is my assets, to the bank, it is their liabilities. When I put money with the bank, the money do not belongs to the bank. It is almost as if I'm lending the bank my money, and then so the bank owe it to me. Anytime I want to withdraw it, they must allow me to do so, right? For the assets is the let's say I took out a loan from the bank. So the loan that I took up is then the assets of the bank, right? Because it belongs to the bank, I need to return to the bank. If I take let's say a 10-year loan for my car, I need to slowly repay until I eventually pay it back to the bank. So that is the assets that they lend to me. Right? I hope this explanation makes sense to you, right? So because with that loan and deposit, then we can start to understand, right, how the bank works, what the bank needs to make their business work, and then how we can then look at this matrix and compare it across different banks and see how they perform, right? So let's look at the assets portion first. On the I mentioned the assets portion, you have the total loan. So one thing that we want to see firstly is that the loan growth, right? A bank, the only way, that's how they earn money, right? That interest portion. So the more money they lend out, the more loan they write, right? Then the higher their income should be, right? That's in assumption that all the money, all the loans that they took up, the people pay back. There's no bad loans, right? But so loan growth is one important key that we look at, because that's how the bank make money, right? Then we want to look at allowance for loan loss. Right. One very good example is last year during the start of the COVID-19 pandemic, right? Because of the huge uncertainty, right? Many people are afraid of the recession that's going to come and how long the recession is going to last. You know, the Singapore government has launched forth budgets after budgets, right, to help to prop up the economy, to make sure that the people don't suffer, the economy don't suffer, right? And the banks also, they are being asked firstly to reduce the dividend payout, and then secondly, what the bank did is that they then set aside more allowance for loan, right? So when they have this income that they earn, instead of reporting it out, you know, and paying out to the investors as dividend, they will have to set aside a portion just in case, because of the huge uncertainty, because of the recession, right? They may not be able to collect back some of the loans, right? So then this is allowance for loans that they need to set aside. Now, of course, now when everything starts to clear up, they see that hey, actually not a lot of default as they have initially expected happen. So then they are able now to pay out all this money that is set aside back to the shareholders. Then we also have the non-performing loan over total loans, right? So non-performing loans meaning those bad debt that they couldn't collect back. So you can see the higher this is, means the worse off the banks has performed. Then it means that their credit check, they need to work on it. They did not do a thorough check on the people that they lend the money to. Then under deposit, we have two portions, interest-bearing deposit and non-interest-bearing deposit. So we want to look at deposit growth as well, because you need to have this deposit before you can loan it out. And so one key feature metrics you look at is loan to deposit ratio. So therefore, on simplistic form, sometimes if you want to do a very quick check on how the bank is performing, we just look at the equity, because if the loan grow more, they have more loan growth, it means they have higher assets growth more than the liabilities, the equity will go up, right? Okay, so I'm just going to do a very quick case study among these three local banks and look through some of these metrics that we have covered and do a very quick comparison on the three of them just to see how have they been performing so far, right? But one thing I want you to take note here is that you can see DBS 23% of the loan market share in Singapore, UOB 20%, OCBC 15%. So the three banks together took out almost 60% of the entire Singapore loan market share. Of course, you have these other various international banks. They are very big in their own country, but over here in Singapore, their portion is not as big as the three local banks, right? And this is a trend that you need to take note of, because it's a trend wherever you go to, right? Even in the US, you have like JP Morgan, very big. Like in Hong Kong, HSBC, like almost like half of the entire Hong Kong market. But yet, they are not able to replicate their success in other countries, right? So banking business is a very local business, right? No matter how hard DBS try to break into the Hong Kong market or the China market, they will always end up being just a peripheral small player, because it's not easy to break into a local market. It's a lot on a relationship. You need to trust the bank. You need to trust the money that you put up with them. So so you usually end up very local. The impact is very localized. Okay, so very quickly you compare these three banks. Firstly, on loans, okay, you see two columns here, 2016, 2020, and then we put all the in between. I just want to look at the difference between the two and how it has performed so far. So this is a loan growth analyzed over the past 5 years. So for DBS and until UOB. So in this respect, UOB has performed better in terms of its loan growth. How about deposit? Deposit, DBS performed better, right? It has grown its deposit by 10% annualized, whereas OCBC performed the worst of among the three in this respect, right? Just like I mentioned, for the total deposit, we have the interest-bearing deposit and the non-interest-bearing deposit. So for the interest-bearing deposit, UOB grew the most, 7.1%. And you have DBS that grow the non-interest bearing deposit the most at 20%. So effectively almost doubled its size since 5 years ago. Okay, I didn't point this out just now, but why is non-interest bearing deposit important? Because can you imagine this? The cost to the bank's interest income is interest expense, right? The interest they need to pay to the depositor. But what if I tell you that there is this portion of the deposit that is kept with them that they do not need to pay interest at all, right? So wouldn't it be better if the bank has more of this? Because then it means that whatever they have lent it out, they loan out, interest they collect, then they have lesser to pay out to, right? So therefore, non-interest bearing deposit is an important factor to also to consider when we are studying the bank. And the reason why the bank have a non-interest bearing deposit is sometimes that it could be a checking account, or it could be some corporations who want to do a major acquisitions a few months down the road, so they need to set their funds aside into a special purpose vehicle. So then they put it with the bank. So because the bank is now doing them a service, they then do not offer to pay them any interest for the money they put up with the bank. So then there's a plus, right, to the bank to have a bigger portion of the non-interest bearing deposit, right? So then, okay, so the next thing we want to look at is loan to deposit. So loan to deposit basically is also starting on the riskier part of the banks, because if you have a loan that is higher than the deposit, then you'll become more than 100%. So it means the bank is growing very aggressively, but there is a danger that if, let's say, some black swan event hit, a recession happens suddenly, all the depositors nervous and want to start to withdraw. So then the banks will face into a problem with this. If they have this, or you have a huge bad loan, bad debt, right, that they can't collect back, then those who have a higher number will then run into a problem. So so for this, usually 80+% is a fair numbers to be in. And even if banks, sometimes you come across that they may temporarily, momentarily went up to close to 100, also don't be alarmed. It's more for us to study the trend, whether do they consistently stay high, or what's the management doing? Are they putting effort to control? So over here, we can see that since 2016 to 2020, the DBS have put in some effort to reduce this by almost 8 percentage point. So, and that is really because of its increase. You can see here, deposit growth, and also the non-interest portion that's even better, right? That causes this to drop. Right, so DBS in that situation, it has performed better. Okay, this is the net interest margin that I mentioned just now. So among the three, they're pretty similar. You can see, like, of course, you can see UOB is better, DBS is slightly lower, but it's not a major difference, right, that we need to be too concerned of, right? But so unless you see a numbers that jump out, then you will then need to look deeper into it. Okay, so you have, okay, sorry, I got a question from Lady about asking about DBS. Okay, I really don't know why DBS did on a day-to-day basis. It could be, there are various factors that comes to influence the bank's movement on a day-to-day basis. But later on, I'll show some charts that maybe I'll explain on my overview of the bankings for, I mean, their price right now, as well as what I think it will be like going forward, right? Yeah. Okay, so this is basically net interest deposit over total deposit. So you want to be higher, meaning that, sorry, non-interest deposit. So those that have a higher percentage is better. So OCBC is better in that sense. Non-performing loans over total loans, OCBC also slightly better than the other two. Okay, so the how about valuation? What then do we look at when we want to, if you want to ask me that, is there a single matrix that I just look at to understand the bank? I mean, all these loans growth, deposits, net interest margin, you find too many things to look at. I just want to look at one matrix, right? I'm going to show it to you now, right? So, okay, this is not confusing, so don't be alarmed by what the numbers you see here. So basically, you have a column here that shows you the total deposit growth for all the various banks. This is Singapore banks, Hong Kong, China banks, and the US banks. Right, so take for example here DBS, deposit growth, analyzed 9.3%, loan growth 8%. Okay, so and then the equity, remember just now I mentioned about equity meaning assets minus the liabilities. So this is also known as the book value. So then the book value growth is about 6%, which is quite close to the loan growth, right? So over here, you have this Postal Savings Bank of China. Take note that the loan growth is almost 19% analyzed, and you look at the equity, 21%. So then look at Citigroup. The loan growth is 1%. We have deposit growth close to 8%, but look at the equity growth is -2%. So therefore, if you want me to summarize that, if from out of today's session, if there's nothing else that you can pick up, then pick up this thing, and that is the equity, the book value, right? Is a very quick key for us to understand the bank's valuation, where it stands right now, and then how likely it's going to perform based on the price to book ratio, which is derived from the equity, derived from the book value, right? So this last portion here that I highlighted in blue, in the middle here, P over B is the price to book ratio, right? So you're using the price of the stock price or the market cap divided by the book value per share. So the lower the number is, basically the more attractive, right? The bank is, right? But you must take this into context, the historical context of the banks. In what range do we usually trade in? The Singapore 3 local banks, they are pretty similar in their growth, right? In their valuations, so they are stay quite close to each other. But if you compare it with like the Chinese banks, here you can see that, wow, 0.5 times, which is very attractive, 0.4 times, very attractive. But why nobody is buying it, right? So, and then with the US portion, which are usually higher, more than 1 times, and then over here you can see Citigroup 0.8 times. Why is it so low? Because you know that it's low because it's not growing its equity, right? It's not growing its loans, so investors don't like it. So when investors don't like it, they price it at a lower multiple, right? So this is a zoom in on the, so they can see clearly price to book. Then put it side by side, we look at the net interest margin, and then the last column is price to book to growth, which I'll touch on later on. Okay, so price to book, then how do you then use price to book to value to look at a bank? So when you are using price to book, you have to look at it historically, because if you compare it like what I did, if I compare the Chinese bank, then I'll think that, oh, Chinese bank is cheap, I'll just buy the Chinese bank. But then for those who invest in Chinese bank for over the last few years, you know that it just doesn't go up, it just keep getting lower. So you need to compare it with the bank historical performance, price to book performance. So roughly for price to book, you can categorize them into 3 categories. One is a stable price to book, so they trade in the range. Like this is DBS on a monthly chart. So price to book, it trades within a range of about 1.4 times to 1 times. So I used to say that every time it is trading near to the 1 times, then it is in an attractive zone. If it's trading close to the 1.4 times, then it is not so attractive. So DBS, right, is trading towards the high zone level, right, for the price to book. Right, does it mean that DBS will go down all the way from here? No, because it has ever went up higher than that before. So of course, a lot will depend on the performance of the economy. A lot will depend on the performance of the banks. Because if, remember, price to book has 2 variables. You have price and you have the book value. If the book value increase, then you will bring down the price to book ratio. So thereby, the investor will come in to buy up the stock, and the price will go up, and the PB will then trade back towards a higher region. It also reflects the general sentiment in the market. When the sentiment is bullish, you will award a higher and are more tolerant of a higher price to book valuation. So another one scenario is where that is rising. So for this example, look at JP Morgan, right? It's in a trend, but in a rising trend. So it doesn't really fall back way down below. And if you really study deeper into it, it can be explained, right? Because JP Morgan has also been diversifying and going more into earning more from the non-interest income portion. So not just dependent. If they are fully dependent on the net interest income, then of course they may have a different outcome, right? Because due to the interest rate being very low, that portion is likely to be more tougher, right, than the non-interest income portion. So then you also have an example of falling price to book ratio. So this is HSBC, right? It's in a range, but it's falling off. But even in that scenario, right, when it's generally not performing as well, but if you know that as an investor, if you try to buy near to the lower boundary, you will be better off, at least in the short term. You'll be able to enjoy a short-term rise. And this short term is not really short, right? It's like almost 1.5, or it could be up to 2 years of increase or uptrend, right? So if you know that if you buy closer to the lower boundary, you'll be better off. When it's trading at a higher boundary, then be patient and wait for it to come down, right? So I don't think I have time to cover this part of the price cycle. But basically, this is just an indicator that I've created for my own use, and also I use that to advise my client. Because as you can see, different banks, they react differently in their price to book. Some of them are in the uptrend, some of them in the downtrend, some of them stable. So basically, using this price cycle index, I'll just be able to normalize them, so that with one indicator, I can see that basically what I'm trying to do is to try to buy it when they are in the buy zone, which is when they are on the low side. So this is DBS, this is JP Morgan, this is HSBC. So it's similar to what, like if you were to use a price to book, you try to draw a trend line, trend channel. You can also pick up the same way. Just that by using this indicator, I need not then draw a different trend channel for different banks. Just with one indicator, I can quickly flip through various banks to understand where are they at right now and whether are they still attractive. So for now, would like to, if I want to buy the banks, since this DBS, I will wait for it to fall closer to this region here before looking at them. So at a higher region, if I haven't bought it, yet, then I will not buy it. Unless if I'm holding on to it, then I may continue to hold it, because in the long run, the banks will follow the economy, right? If the economy rise, the banks will do well, right? But of course, at a higher multiple, you can't expect a huge increase. You can't expect like kind of those tech stock kind of increase, like 20, 30, 40% a year, but more in line with the economy, like which is like maybe 5%. Or even maybe 7% when you include the dividend payout. Okay. Okay. So lastly, I just want to cover this on the twin engine of growth. Growth estimate, when we invest, right, what we want to see is that we want to see that our investment grow, right? So how an investment can grow is when the company that we invest in makes more money, right? Because the more money they make, then the higher the share price will be priced at, and also then they will be able to distribute out more of this to us as investors in the form of dividends, right? So there's one portion whereby you have the revenue growth, right? The other portion is the price multiple expansion, which is what I've just mentioned just now on the price to book rate multiples, right? You want to buy when the multiple is low, because when the multiple is low, then the next step for it is then it will be expanding up to a higher level, right? So multiples can expand and it can contract. So if you buy the multiple that is high, then it can only contract. Of course, if you have a revenue growth that is higher than the multiple contraction, then the investment will still end up well, right? You're still earning more. But if you were to, let's say, for example, I showed a picture of the aeroplane. If you were to choose an aeroplane, would you choose one with twin engine or one with just one engine, right? Of course, the twin engine is safer and it should be faster, right? And also, just in case if you only have one, if the one fail, then that's it, right? But if you have two engines, if one fail, then the other one can still carry it through. Similar for investment. If I have price multiple expansion and revenue growth, then I know I stand a higher chance of seeing a greater return in my investment. Right. So when it comes to banks, right, this is one metric that I look at, right, which is price to book and growth ratio. So basically, you use the price to book divided by the growth of the banks, and then you get a number, and that number you want it to be as low as possible. So for that, then you can compare, right, across various banks and see which one is better and why is it so low. Then you need to study a little bit deeper. Right, so for growth, remember, we need to look at net interest income growth and non-interest income growth, right? Because increasingly, this non-interest income is getting very important, right? In the past, banks is almost like 80% net interest income, because when the interest rate is high, this is easy money for them, right? They just take the deposit, just lend it out, collect, and then of course they need to do their proper credit check and make sure there's no bad debt and such. Right, but now with the interest rate getting very low, right, then they need to be more careful, because they're earning lesser from there. So they need to increase their income, and more will come from this non-interest income. We see that in the major banks like in JP Morgan, like now their net interest income is less than 50%. In our local banks as well, it's getting lower, right? For example, okay, over here, just look at the three banks. Look at the look at this last column on the net interest income ratio, right? So in the past, DBS is like almost 63%, now it's 59. OCBC is 60%, now 55. The only bank that increased on the net interest income ratio is the UOB, meaning their net interest income still at a higher percentage. Look at JP Morgan, I mentioned to you, 47%, and now it's 43%. So which means more, now they're earning more from the non-interest income than their net interest income. Okay, so three banks to consider. One from Singapore, one from Hong Kong side, and one from US. Okay, for Singapore, my preference is actually OCBC. Just now you see the comparison. It seems that individually the DBS or UOB has performed well, but in totality, actually I prefer OCBC. Firstly, its PB ratio is lower, and then it has higher net interest margin, and also its non-interest deposit is a higher percentage, meaning that it's a bigger portion of the deposit that they did not need to pay interest for, right? So whereas for the loan growth, deposit growth is quite okay, lesser than the other two, but in totality, my preference will be OCBC, and also because when I calculate the PBG, it is slightly lower than the other two. For Hong Kong side, actually my preference is this bank here. It's not the usual big banks that we are familiar with. In fact, this one is quite newly listed since 2017. It's PSBC, ticker is 1658. So the reason I like this bank is because it has huge growth, and it doesn't have the legacy loan problem that the other big banks have, because all the other big banks has gone through the cycle whereby there's a huge credit expansion in China. So and one of the reasons why the Chinese banks are trading at such a low PB is really because investors are very skeptical of their books. They are not so sure whether what they are reporting is, I mean, the assets is really good assets, healthy assets or not. So whereas for PSBC is relatively new, so it doesn't have this legacy issue. So meaning it has a fresh start in that sense. So then this is one of the banks that I prefer that's listed in Hong Kong. For US, I like this Fifth Third Bancorp. So so it has very good growth, and the loan, net interest income and non-interest income growth is also very good. The price to book is relatively low, so also the PBG is pretty attractive. Okay, let me look through some of these questions. Okay, okay, DBS basically, as I mentioned, among the three banks, the price to book ratio is slightly higher than the other three, but nevertheless, the Singapore's three banks basically move quite in tandem. So whichever you buy, I mean, there is a difference. Whichever you buy will be in a general scheme of things move together. But from at this point, my preference is OCBC, as I mentioned, because of the low valuation. Okay, Fabio asked about a PB cycle. So basically, this is my own indicator. I will not be sharing on how I plot it, but it's an indicator I use to service my client. Commission, there's no commission charge for MT5. MT5, you can't trade futures contract, but you can trade futures assets, related assets. Like let's say if you're talking about Dow Jones, they'd have Dow Jones, S&P, Nasdaq, CFD under MT5, and they are all zero com. Okay, Raymond asked about the usual PB range for Chinese banks. Okay, as you can see, they are in a downtrend PB range. So I couldn't determine whether, because every time I think that this is the most lowest they can go, it always surprises me when going lower. So therefore, really, like as I mentioned, there are a lot of skepticism about the assets, because when you look at PB, the determining factor is the book value, right? Book value is made up of asset minus liabilities. So if you are very skeptical on the assets, meaning that you think that maybe you report assets as, let's say, 10 billion, but the investor may think that maybe it's not 10 billion, right? Perhaps it's only 5 billion, right? So in that sense, then when you look at this number and without any form of verifying, then it becomes even tougher, right, for people to find a foothold to guess. That is why that even though you look at the incomes are growing and growing, but why is the bank price not going up? And that's really because of that portion here, the skepticism as well as the sentiment value. So I couldn't determine a range yet for them, but definitely now is trading towards the lower portion, of the downtrend range. But as I mentioned, as I shown just now on the HSBC, if you buy it when it's low, it may get lower, but at the very least, in a short-term basis, and a short-term meaning like at least maybe 12 months to 18 months, there may be a chance that it will go up, right? So it is still safer to buy when it's low than when to buy when it is high. Okay, so these are some of the value-added service that I provide. One-to-one coaching for my clients, market updates. I provide WhatsApp trading ideas to my clients. For futures clients, I'll send out futures ideas. For forex clients, I'll send out forex ideas. For my stock clients, I'll then send out stocks investing ideas. So I also have done some collaboration with Phillip Futures. We've written down some deeper analysis on stocks. So these are the three that I have posted recently. You can refer to them and go and check them out and read up and so you can have a better understanding of my thought process when it comes to choosing investment to look at. And also just take note that if you're interested to open a trading account, futures or the forex trading account with us, or MT5 account with us, we have this promotion that's running on at the same time. Okay, so thank you for your time. Eric here. My contact is here if you want to contact me. Right, if you want to follow me, you can join me, follow my LinkedIn profile. I have a collaboration with my another stock broker colleague on this website called the stockwhisperersg.com. So over there also we post out our views on various stocks. It could be technical analysis, it could be fundamental analysis. Some of them also based on the PB cycle index I mentioned. Not just PB cycle, we also use it on the PS cycle and the PE cycle. So we use it in conjunction together with the fundamental, the growth, the story, and the timing tools. Using the technical analysis to try to determine the optimal point to invest and to trade the stocks. Okay, that's all the time we have for today. Thank you so much for being such a wonderful audience for tonight's webinar. So a link to the recording of this webinar will be made available in our follow-up email tomorrow. If you have any query on the webinar or would like to learn how to get started, simply reply to our email and we will get in touch with you. This is Eric signing off. Have a good evening ahead. I wish you all the best in your investing, your trading journey. Right, any questions that I did not get to answer today or you thought of, just feel free to put it on the feedback form or reply to our email we send to you, and I'll do my best to get back to you. Thank you. Hope to see you soon.